Hi, my name is Yu and I'm from Group 8. In this presentation, I will discuss my analysis of F company financial information. So this is the presentation's order. First, I will analyze the performance of F company. Then I will compare the performance of the three companies to determine which company I would rather do business as a supplier. So first, let's look at the profitability ratio. It is used to evaluate the ability of a business to generate earnings relative to its revenue, assets, and shareholder equity. Profit margins is one of the profitability ratios that is commonly used to measure the degree to which a company or business is making money. It represents what percentage of sales became profit. Looking at the chart, it is showing a downward trend. The ratio has decreased significantly in recent years, meaning the business is not effectively turning revenue into profit. This is because net income decreased while revenue is stable, so the ratio decreased. Specifically, the decrease in net income indicates that the company is not likely to pay off its current debt. Moreover, a fall in net profits could indicate that the business is not operating at peak efficiency. Overall, it may create more risk as the company doesn't have much cash available to deal with any problems that may occur. Next is gross profit margin. Gross profit margin tends to decrease over the year. The reason it declines is that cost of goods sold is likely to increase over time. Therefore, it affects the ability of the company to make a profit. In general, the gross margin doesn't have much change compared to the profit margin. This scenario shows that the company is not in good position to make money or to seize any opportunities that may come because of the low net income. Therefore, it creates more risk for the business as well as investors. Moving on to rise earning ratios, it is an indication of how many times earnings the market is prepared to pay for a share. Looking at the chart, at the end of 2018, price to earnings ratio has a tendency to increase dramatically. This is because of considerable decrease in earning per share and a slight increase in market price. It could mean that the stock of a company is overvalued or the investors expect high growth rates in the future. Also, compared to GM and FCAU, F company release more shares, so that's why earning per share is intensively low. To put that aside, this is not a good sign because earning per share decline, which means the company is losing profit. Overall, if investors invest in an overvalued stock, they might run the risk of losing money if it fails to meet high earnings expectations. So next is the capital structure. It gives an insight into how much equity liability there is per dollar and shows how dependent an organization is on equity financing. And it is categorized into two main types: debt to assets ratio and debt to equity ratio. So debt to equity gives an overview of how much liability there is per equity dollar and show how dependent on organizations is on equity financing. It can be seen that debt to equity experienced a dramatic fluctuation over the given period of time. It went up to over 7 in 2016 and declined to around 6 in 2017. Although in recent years, the debt to equity increase is still lower compared to 2016, which were higher, so there is no concern that the company is associated with high risk. Debt to assets is a measure of the extent to which an organization's assets have been funded by lenders or creditors. So looking at the chart, it had a trend to decrease and increase because of the rise in total liabilities. This is unfavorable for the company as it indicates that a higher percentage of the assets are debt financed. Additionally, a higher ratio increases the difficulty of obtaining loans for new projects, as the lenders will see the business as a risky asset. So to fully understand the capital structure of the business, let's have a look at the long-term debt. The trend here is it went up and down, but it only experienced a small fluctuation. Overall, from 2017 to 2019, it is quite stable, although it decreased a little bit. Long-term debt had its cons and pros. Regarding its pros, long-term debt gives the business instant access to funds without worrying about short-term payment. Also, a higher long-term debt could mean the company is investing more in equipment and assets and not in a risky situation. However, one major drawback of a long-term debt is that it will limit the business monthly cash flow. The higher the debt balances are, the more each month the company commits to paying on them. In conclusion, the company's assets are likely to fund by debt in general, whereas the debt to equity ratio had a tendency to increase in recent years, indicating that a company may not be able to generate enough cash to satisfy its debt obligations. Generally speaking, it's not a bad sign, but also not a good one. So in order to decide which company I would prefer to do business, I will compare the three companies' inventory turnover, quick ratio, and payable period. Because as a supplier, I care about having a long-term business partner and the ability of the company to pay off its current debt when due. First, let's have a look at the inventory turnover. It means the higher the turnover, the better. Inventory turnover shows how many times during a given period of time during a given period a firm has sold and replaced inventory. This means the higher the turnover, the better. In this case, the company F has a much higher turnover compared to the others, although it suffered from a slight decrease. Next is the quick ratio, which shows the ability of a company to pay its current liabilities without having to sell its inventory or obtain additional funding. Though the quick ratio of F company decreased, it is still higher than 1, so it means the company is likely to get rid of its current liability. Meanwhile, GM and FCAU have quick ratios that less than 1, which means the two companies may not be able to fully pay off its current liabilities in the short term. And lastly, the payable period, which is the average number of days it takes for the company to pay off its current liability. It is notable that FCAU had the highest payables period and also experienced a slight fluctuation, whereas Company F has the lowest among the three companies, and this is more stable than others. In conclusions, based on the three factors that we just analyzed, I would say F company is the company I will do business as a supplier. So this is the end of my presentations. Thank you for listening. And here is the citation of all the definition.